European manufacturing expanded at a more modest pace in August. It indicates the recovery has slowed, but it does remain on track for some growth. We partner now with the FT to bring you Lex on Bloomberg, so you can get a sneak peek at the Financial Times flagship column a day early. Edward Hadas joins us now from London with some reaction to this latest manufacturing data. Edward, what does it say? Still indicates that going forward, we've got a little bit of growth expected in the European economy.
You know, last year about this time, people were still thinking 2010 was going to be a flat or even a down year for European GDP. And now we're talking about, maybe 1.5% GDP growth in Europe. And these latest numbers are in line with that kind of number, perhaps even something a little bit higher if it keeps up at this rate. So basically the economic news coming out of Germany, out of Europe, out of the Eurozone is really quite strong and seems to be holding up through the summer pretty well.
What does ultimately a little bit of growth mean? I mean, last week we know Bloomberg spoke with Axel Weber. He said, hold on, let's not take stimulus out of the equation too quickly, making that cautionary note as well.
Yeah, you know, it's better to have growth than no growth, but it would be better if you had growth with the financial system in sort of good shape. Remember, we've still got very high deficits. Those are coming down in Europe faster than the U.S., but that contraction could hit into growth rates. You've still got ultra-stimulative monetary policy, as Weber was talking about. When you try and normalize that, that too could hit into growth rates. And the Eurozone, of course, has that particular problem of regional solidarity. A lot of the growth is coming out of Germany. There's still, basically all the GDP numbers were positive surprises except for Greece. There's still problems in the periphery in Europe. So you're still talking about a region with a lot of challenges for growth.
Yeah.
All that being said, if you look at the Europe, and remember it's got much slower population growth than the U.S. GDP per capita, the recovery there is about the same. It's a little faster. I mean, the record in Europe isn't that bad, but it's still a stressed situation, shall we say.
Edward, we're just showing the euro right now, and obviously we're showing the reaction in the markets today in Europe. They are positive. Is there still this general feeling around the world right now that Europe versus U.S. for investors, that the Europe might be, in fact, a little safer than the United States?
Yeah, a couple of months ago it was the complete reverse, and then the U.S. data started to come in weaker. But really, if you look at it from a fundamental point of view, the U.S. is where all this started. It had the big correction in housing. We're still not really over that. The European economy's problems basically had to do with the decline in world trade. As that rises, Europe should be a little safer than the U.S.
All right, Edward, thanks for your time. That's Edward Hadas with the Financial Times.